Welcome to the special broadcast on SABC3. It's a little bit earlier than usual. We'd normally come to you on a Thursday afternoon, but tomorrow being a holiday, the Reserve Bank's Monetary Policy Committee has decided to move its press conference for the decision to a day earlier. And speaking of which, the government is on the podium, ready to deliver her speech.
Growth, rising inflation, a depreciated currency, a wider current account deficit, as well as difficult labour relations, while unemployment remains stubbornly high. Since the previous meeting of the MPC, the domestic inflation outlook has deteriorated somewhat. Risks posed by the depreciation of the rand exchange rate have overshadowed the more favourable developments, including low electricity price increases and some moderation in food price inflation. Nevertheless, inflation is expected to remain contained within the target range, apart from a temporary breach in the third quarter of 2013. The domestic economic growth prospects remain fragile amid continued tensions in the labour market, particularly in the mining sector. The global economy is still characterised by a multi-speed recovery. However, recent events in Europe, particularly as they affect Cyprus, have increased risk and uncertainty in the region, and have the potential to reignite the banking and sovereign debt crisis and undermine growth prospects further. The global outlook is also clouded by the fiscal gridlock in the United States that remains unresolved. The year-on-year inflation as measured by the Consumer Price Index for all urban areas was 5.9% in February 2013, up from 5.4% in January. The upside surprise in February was mainly due to the increase in medical insurance costs, which resulted in the contribution to CPI from miscellaneous goods and services increasing from 0.7 percentage points to 1.1 percentage points. This category also impacted on core inflation, which increased markedly from 4.7% in January to 5.3% in February. Petrol prices also contributed to the upward trend, having increased by 11.9%. Food price inflation measured 6.3%, down from a recent high of 7.5% in November 2012, and its contribution to overall inflation declined from 1 percentage points to 0.9 percentage points. Administered prices increased by 8.9% and by 7.5% excluding petrol. The Producer Price Index for final manufactured goods measured 5.8% in January. The inflation forecast of the bank reflects a slight deterioration in the inflation outlook for 2013 compared with the previous forecast. The forecast incorporates the new CPI weights and rebasing announced by Stats South Africa, as well as the low electricity price increase of 8% granted to Eskom by NERSA. Inflation is now expected to average 5.9% in 2013 and 5.3% in 2014, compared with the previous forecasts of 5.8% and 5.2% for these respective years. Inflation is expected to breach temporarily the upper end of the inflation target range in the third quarter of 2013, when it is expected to average 6.3%, and then to moderate gradually to 5.2% in the final quarter of 2014. This deterioration is largely due to the depreciation of the rand and higher petrol prices, which more than offset the impact of the low electricity price increases and a lower starting point. The forecast of core inflation is more or less unchanged for 2013, but higher for 2014, yet still indicates the continued absence of significant demand pressures. This measure is expected to peak at 5.1% in the second quarter of 2014 and to average 4.8% and 4.9% in 2013 and 2014 respectively. However, this forecast is likely to be adjusted upwards in the light of the increase in medical insurance costs announced earlier today. Inflation expectations, as reflected in the Reuters survey of analysts conducted in February 2013, have remained more or less unchanged since December. Expectations remained anchored within the target range, but close to the upper end, and, as with the bank's forecast, the peak is expected in the third quarter of 2013. The global economic outlook presents a mixed picture following a disappointing fourth quarter in most of the advanced economies. Recent data from the United States indicate positive trends in the labour market and household consumption expenditure due in part to positive wealth effects from the housing and equity markets. However, uncertainty about the possible negative impulse from fiscal tightening continues amid political differences over fiscal policy. Economic growth is still expected to remain below trend in 2013. The outlook for some of South Africa's other main advanced economy trading partners is less positive. The Eurozone remains in recession and is not expected to recover before mid-2013 at the earliest. The tail risks from a sovereign debt crisis appeared to have subsided, but the uncertainty created by the inconclusive Italian general election and the crisis in Cyprus has renewed concerns about the stability of the region. The outlook for the UK economy remains subdued against the background of continued fiscal austerity. Growth prospects in the Asian economies are more positive. The Japanese economy is expected to be bolstered by positive consumer sentiment in response to fiscal and monetary stimuli, but the response on the capital expenditure side is still cautious. Nevertheless, an improved growth performance is expected, particularly given the 18% depreciation of the yen against the US dollar since October 2012. Growth in China is expected to be sustained at relatively robust levels as fixed investment expenditure remains strong, despite a moderation in consumption expenditure growth. Growth in other emerging markets remain positive. These trends suggest that monetary policy in the advanced economies will remain accommodative for some time, despite recent fears in the financial markets of an early reversal of quantitative easing in the United States. The relatively weak growth outlook in the advanced economies has contributed to the subdued global inflation environment. The exchange rate of the rand continues to pose the main upside risk to the inflation outlook. Since the beginning of the year, the rand has depreciated by 8.4% against the US dollar and fluctuated within a range of 8.45 and 9.26. However, given the significant realignment of global currencies, and particularly the depreciation of the Japanese yen and the pound sterling against the US dollar, the trade-weighted depreciation since the beginning of the year was more moderate at 5.6%. Domestic factors contributing to the recent rand depreciation include continued work stoppages in parts of the mining sector, which also have the potential to disrupt electricity supplies, and the further widening of the deficit on the current account of the balance of payments, which measured 6.3% in 2012. Some narrowing of the deficit is expected during the course of the year in response to the depreciation, although the degree of response will be constrained by weak demand from advanced economies, as well as strong infrastructure-related import demands. Mining export growth will also be dependent on the resolution of labour market issues, with a resumption of full production, and on the extent of possible shaft closures. Equity and bond flows to emerging economies have generally moderated in the past few months, making for a more challenging global environment for financing the deficit. Inflows into South African bond and equity markets have, however, been sustained, and year-to-date non-resident net purchases of equities and government bonds have totaled 6.1 billion and 11.3 billion respectively. These flows have, however, been volatile, and the growing proportion of bonds owned by non-residents, currently around 37% of the total outstanding stock of debt, could constrain the pace of inflows. The rand is likely to remain sensitive to both domestic and global developments. The exchange rate is expected to remain volatile and subject to overshooting, and a further sustained depreciation would increase the upside risk to the inflation outlook. The Reuters Econometer survey conducted in February shows that most analysts still expect the rand to appreciate from current levels during the year, although the degree of dispersion is indicative of the uncertainty around these forecasts. According to this survey, the consensus forecast for the rand-dollar exchange rate at the end of 2013 is 8.61 rand, with a range of forecasts between 9.19 rand and 7.80 rand. Domestic growth prospects remain relatively subdued, notwithstanding a better-than-expected fourth-quarter GDP growth outcome and positive developments in the mining and manufacturing sectors in January. The economy grew by 2.5% in 2012, having recorded annualized growth of 2.1% in the fourth quarter, despite a 9.3% contraction in the mining sector. The moderate pace of recovery is expected to continue in 2013. The bank's forecast is for growth of 2.7% this year, marginally up from the previous forecast of 2.6%, and 3.7% for 2014, compared with the previous forecast of 3.8%. The risks to these forecasts are assessed to be on the downside. The flat trajectory of the bank's leading indicators of economic activity is consistent with this forecast. Growth this year is therefore expected to remain below potential output growth of 3.5%, and this is expected to result in a slight widening of the bank's revised estimate of the output gap, which at 2% reflects the continued subdued state of the economy. The mining sector recorded year-on-year growth of 7.3% in January, with 3-month-on-3-month growth of 5.4%, following 4 consecutive months of contraction. Nevertheless, the sector is expected to remain under pressure given the unsettled labor relations environment. The outlook for manufacturing appears to have improved, but this recovery is still very tentative. The sector grew at a year-on-year rate of 3.9% in January and by 1.8% on a 3-month-on-3-month basis. This was consistent with improvements in the Kagiso Purchasing Managers Index, which increased from 49.1 in January to 53.6 in February. Growth in gross fixed capital formation, which measured 5.7% in 2012, has been on a moderate upward trend since 2009, driven mainly by investment growth of around 9% by public corporations and general government. Private sector investment growth moderated from 4.6% in 2011 to 3.9% in 2012, due in part to excess capacity in manufacturing as well as electricity supply constraints. While household consumption expenditure has been the main driver of growth since 2010, its contribution to growth has been diminishing. The general absence of demand pressures in the economy is reflected in the continued moderation in the growth in real consumption expenditure by households, which grew by 3.5% in 2012 compared with 4.8% in 2011. Nevertheless, growth in consumption of durable goods remained robust at 11%, compared with demand for services, which grew at only 1.8% in 2012. Sales of new motor vehicles declined on both a month-on-month and on a 3-month-on-3-month basis in February. Retail trade sales in January appear to reflect this weakening trend, with a 3-month-on-3-month decline of 0.7% and a lower than expected year-on-year increase of 1.9%. There are indications that consumption growth may moderate further in 2013 amid a slower real income growth, higher inflation, elevated household debt levels, and a possible slowdown in credit extension to consumers. 12-month growth in bank total loans and advances to the private sector measured 8.9% in January, following growth of 10% in December. Loans and advances to the corporate sector grew by 7.5% in January and to the household sector by 9.9%. Growth in general loans to households, mainly unsecured lending, moderated to 30.1% following a recent peak growth of 39.3% in June. General loans to households amounted to 8.3% of total loans and advances, and 14.6% of loans and advances to households. Growth in this category of lending is likely to be constrained by lower income growth and high household debt levels. Household debt to disposable income measured 75.8% in the final quarter of 2012. Non-mortgage debt as a percentage of total household debt increased from 37% in the third quarter of 2009 to 46% in the final quarter of 2012. The trend in wage settlements remains an upside risk to the inflation outlook, although recent data is somewhat contradictory. The minimum wage in the agricultural sector has been increased by 52.2%, and indications from the Andrew Levy employment publications are that wage settlements in collective bargaining agreements picked up significantly from 6.8% in the third quarter of 2012 to 8.2% in the fourth quarter. According to Stats South Africa, average salaries and wages per worker in the non-agricultural sector increased over 4 quarters by 7% in the final quarter of 2012, down from 8.9% in the previous quarter, while unit labor cost increases declined from 7.4% to 5.7% in the same period. The MPC remains concerned about the possible impact of excessively high wage increases on employment growth. Employment in the formal non-agricultural sector increased by 1% during 2012, compared with an annual employment growth of 1.6% in 2011. This included employment growth of 0.2% in the mining and quarrying industry and a 0.3% contraction in the manufacturing sector. In the fourth quarter of 2012, mining sector employment increased by 1,000 employees, following a decline of 16,000 in the third quarter. Of concern is the seasonally adjusted annualized decline of 0.7% in total non-agricultural employment during the fourth quarter of 2012. The recent national government budget tabled before Parliament reflects a difficult balance between a commitment to medium-term fiscal consolidation and the need for counter-cyclical policy. The projected deficit of 5.7% for the past fiscal year was wider than initially budgeted for, a result of lower revenue due to weaker economic growth. The fiscal deficit as a percentage of GDP is budgeted to be 5.1% in the 2013-14 fiscal year and to decline to 3.6% by 2015-16. The government net debt GDP ratio is expected to stabilize at around 40% in 2015-16, well below the international benchmark for debt sustainability of around 60%. There are indications that the pressures on inflation emanating from food prices may be moderating. Food price inflation at the consumer price level declined from a recent high of 7.5% in November 2012 to 6.4% in January and 6.3% in February. A similar trend is evident in the producer price level, where manufactured food inflation declined to 5.9% in January, compared with a recent peak of 11.1% in November 2012. Similarly, producer price inflation in agricultural products moderated from a recent high of 6.3% in October 2012 to 3.5% in January. Global agricultural commodity prices have declined on average by almost 20% since their peak in August 2012, and expectations are for further moderation in the absence of adverse weather shocks. Administered prices continue to put upside pressure on inflation. Although lower electricity price increases from the third quarter will serve to dampen this somewhat. The petrol price, which has increased by a cumulative R1.24 per litre since January 2013, remains an upside risk. Although global oil prices have declined over the past few weeks, resulting in an over-recovery of the petrol price so far this month, it is unlikely to be sufficient to offset the adverse exchange rate impacts and the fuel levy increases. And a further increase in the petrol price is likely in April. The MPC continues to assess the balance of risks to the inflation outlook to be on the upside, mainly due to the exchange rate and wage pressures. These upside risks are mitigated in part by lower risks from food price inflation. Underlying inflation appears to be relatively contained, consistent with the moderating trend in consumption expenditure by households. The economic growth outlook is more or less unchanged from the previous meeting of the MPC, and risks to the outlook remain on the downside. The unresolved labour disputes in the mining sector pose a significant risk to the exchange rate and to economic growth through their negative impact on export revenues, employment growth, and investor perceptions of South Africa. However, the depreciated exchange rate provides an opportunity for the manufacturing sector in particular to become more competitive despite the challenging export environment. Ensuring that this increase in competitiveness is sustained will require improved productivity and the containment of wage and other cost pressures, which underlines the need to keep inflation under control. The MPC continues to assess the monetary policy stance to be appropriately accommodative, given the persistence of the negative
Welcome back. We have with us distinguished analyst Mohammed Nala from Nedbank Private Capital. Welcome, Mohammed.
Hi, Gunter.
The governor, when we look back, when we look at this speech, and we look back maybe 3 or 4 speeches prior, the revisions we've seen for growth outlook continue to be worse. For inflation also continues to be worse. So the spectre of stagflation hasn't really left us, has it?
Absolutely not. I think if you look at today's commentary specifically, again, they've revised those growth forecasts lower. The inflation forecast set to average, I believe it's 6.3 in the third quarter. So that implies that in the interim of that quarter, that's in fact where we left off, that we should actually be experiencing inflation well north of the 3 to 6% target range that the Reserve Bank has actually set. That being said, they are looking through the cycle. That's really what they should be basing their decisions on. But I think on the balance of risks, the risks still certainly remaining to the upside on the inflation front and to the downside on the growth front, as the governor intimated.
Now, some would say, well, what about the added mandate that we had of pushing growth? Shouldn't she rather do that despite the risk of inflation that it brings about?
I think it's an interesting question. I think if you look at globally, the precedent that has been set by other central banks is certainly to tolerate a higher level of inflation relative to their targets at obviously favouring growth. I think the governor in today's speech certainly ended off reaffirming their commitment to price stability. And why is this important for South Africa? Why should we be different to what's happening globally? Well, first and foremost, inflation tends to hit the poorest of the poor the hardest. Wealthier people are able to hedge themselves against inflation, but the poorest people, certainly a large proportion of South Africa, would be unable to hedge themselves against inflation running out of control. So I think the governor taking a firm line, really focusing on that price stability is certainly important because it talks towards a longer-term strategy that we should be looking at for South Africa as a whole.
Meanwhile, I think I'm playing a bit of devil's advocate here. Meanwhile, the consumer will be saying, though, but she just gave us all these statistics of how we as consumers are struggling. So why doesn't she give us a break?
Yeah, the problem, though, Gunter, is that we've had these historically low interest rates, and the consumer has failed to take advantage of this to actually repair their balance sheet. So if you look at debt to household disposable income, those ratios still remaining close to around 80%. So the consumer, even if, let's assume the governor were able to give us a cut, which is certainly not the case in this scenario, if she were able to do that, it would drive the wrong sort of behavior. It would drive consumption-led growth, which is not the kind of growth we need as South Africa. We need something that's a lot more concrete, that builds capacity and builds competitiveness in terms of our economy relative to our other emerging market peers. So I think the governor certainly spot on in terms of measuring the risks to be rather balanced at this point in time. And yes, there are growth pressures that are exogenously led. We've got Europe, which certainly weighs on South Africa because they are our largest trading partner. But all of this notwithstanding, a further cut in an already accommodative monetary policy stance certainly wouldn't be in order at this point in time.
And one might also add that perhaps companies' balance sheets are strong enough to deal with interest rates as they are, rather than lower ones.
I think it's a bit of a disparate picture. I think if you look at small businesses, they certainly seem to be struggling. If you look further up the spectrum, if you look at larger corporates, they certainly do appear to be a lot more robust. There's a lot more cash sitting on corporate balance sheets. So they've got the scope to actually, tolerate this. They're not going out there and aggressively building capacity. So we don't have a capacity issue in the South African economy. What is important, though, is the governor mentioned that exporters, specifically manufacturers, should take advantage of the fact that the rand has overshot somewhat and really use this in terms of our heightened competitiveness globally.
Meanwhile, though, speaking of the exporters, she started off telling us how our traditional markets are not about to recover. Is it time to look more towards the emerging markets?
Well, here, if you look at it, you've actually seen the signs of recovery come from the United States. So it's not an emerging market story as yet. China has had some signs of positivity, but really failing to follow through. So I think the story right now appears to be the United States benefiting at the expense of everyone else. It's what we've seen with regards to a stronger dollar. And that's where she mentioned, for example, the rand against the dollar has certainly depreciated quite sharply, but on a trade-weighted basis. That's when we measure ourselves against some of our other trading partners. It hasn't performed as badly. It has underperformed, but it hasn't performed as badly. So I think it's really a story of a stronger US dollar, a stronger US economy, rather than strong emerging markets. And Europe, we know Europe still remaining in recession. The UK likely to enter into a triple-dip recession as well. Not looking pretty, because we tend to focus our trade largely on Europe and on the UK as well.
Thanks for your time, Mohammed.
Thank you.
That was Mohammed Nalla from Nedbank Private Capital, shedding some light on some of the reasons behind the Monetary Policies Committee's decision to keep interest rates steady at 5%. Bye for now.